The great thing about Class C properties is when you can buy the property well below what it would cost to build it, you're already in a good place. The need for low-income housing is never going away.
The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back to another episode of the Apartment Gurus podcast. And I'm excited today to welcome my friend Jerry Miller to the podcast. Jerry and I we're members of Mastermind together, capital raising mastermind called Raise Masters. That we'll give him a free plug, Jerry. Why not?
Sure, absolutely. Hunter's a great guy.
Yeah, it's Hunter Thompson's mastermind. Many of you have probably heard of Hunter. Wrote an amazing book on raising capital for real estate and has incredibly powerful mastermind called Raise Masters that we're both members of and kind of networked with each other through that. And Jerry brings a wealth of experience to us and to the podcast to share. Originally started in the single family space. He has 48 single family doors, which is phenomenal portfolio, knowing how much work each one of those is to buy and to run and manage. And it has been in the multifamily space here for about 2 years. He's an LP in 4 deals. And for those of you that may not know, LP stands for limited partners, which is basically slang for he's a passive investor in other GPs deals, general partners deals. So in the syndication model, there's a GP, general partnership. Those are the active investors that go find the deal, underwrite the deal, negotiate, et cetera, and eventually run the deal. And then there's the limited partners that their only job is to bring capital to the deal. And there's, technically speaking, each group has their own LLC and they has different roles inside of the operation. So, and it's a cool opportunity here, I think, for us at the Apartment Gurus to share space and time with somebody like Jerry, who really has the LP side of things dialed in and knows what it takes to be a successful LP. So brings a lot to the table. It has a really good ebook on getting started in real estate investing that you'll want to check out. What's the best way for people to find that, Jerry?
Hey, thanks, Tate. So my website, largogroup2011.com. So you can go there and put your email in and we'll get that free ebook out to you. It's a really short read. It's really designed kind of for the beginner that doesn't know what they might want to do in real estate. And if you're more of a seasoned professional, you might find some useful tips in terms of some of the pros and cons of the various strategies that are in there.
Yeah, awesome. So we'll put that link in the show notes, but that's largogroup2011.com.
That's
so you
right.
want to go there and check that out. And you also want to network with Jerry on LinkedIn, and he's also on Facebook and Instagram. So Jerry, first of all, just welcome to the show, man. I'm really excited to do this with you.
Thanks, Tate. I'm excited too. I love talking about real estate. It never gets old.
Yep. I guess start out with just kind of give us a little bit of a backstory to you and your business path. You're both in your W-2, but more importantly, in your entrepreneurial business path and kind of how you got to where you are today.
Absolutely. I'll give you the 30-second version. So yes, I still have my own consulting company. I like it. A lot of years ago, 2006, I bought my first rental property and I thought, hey, when I make the big time, I'll have 5 or 10, pay them off, and that Social Security and 401k will be my comfortable retirement. Well, you fast forward a lot of years and you see great real estate, so you buy it because you can. That's kind of how over time you get up to 48 doors. But I've really found that I looked into multifamily 2 years ago and just fell in love with it. And really, on first blush, it was like, well, how is somebody going to give me a 15 or a 20% return? I had to figure out, I assume the guy on the other side is rational, right? So if they're making money, that means they're making even more. And I had to understand, how can you make even more money than that and then afford to pay your investors 15 or 20%? And so I really peppered my first general partner team with some questions, and they were really great. They were really helpful. And I really began to understand the underwriting model behind multifamily. You really need to understand how to calculate net income and then how the cap rates drive the valuation of the building. Because one of the things that you learn right away when you get into commercial, you can have good residential skills, but you don't know everything about commercial, even if you think you know everything about residential. There's a fundamental difference. If the house next door to yours is worth whatever it comps for, meaning that what is comparable to that. Multifamily is a completely different animal. You can have two apartment complexes that look identical side by side, but if one's net income is significantly more than the other, and that absolutely can and does happen, well, then the valuation is wholly different. So really just understanding how commercial is different from residential was one of the first things that I had to do to be a decent limited partner. And I would share that with your audience is it's different. Don't come in thinking, hey, I've got 3 rentals, I can evaluate a 100-door apartment building, because it is not the same. So my first tip is really just get educated. It's just like any other thing. If you were going to go into a brand new business, you would assume that you need some sort of education and not just start it. So this is not something to do by the seat of your pants. I know a lot of people that got started in residential that may have gotten away with that. And you probably make $100 or maybe $1,000 mistakes in residential and you just truck along. You can't afford to drop hundreds of thousands of dollar mistakes in multifamily. That would deflate most of us. So one, I would say get educated. But the other thing I would say too is, I think there's this sense in general, if somebody else did it, I'm going to follow them. Well, maybe. Just be careful that in my mind, everybody has different goals, risk tolerances. They have a different investment time frame. You can't necessarily just replicate exactly what somebody else did, because I talk to investors all the time. There are investors that love some of the deals we've done together. There are other people that can't sleep at night. I've had the conversation. If you can't sleep at night, do me a favor. Don't invest. I work with people now. I want to do 10 deals with them. I don't want to do one and lose a friendship over it. Like, I want to be able to really understand what they're looking for. And so I would tell your limited partners out there, really get to know those general partners out there. There's a lot of great people in real estate. There's a handful of bad actors out there. And you just have to really lean in, understand what their history, what's their investment thesis, and make sure that their goals are sort of aligned with your goals.
Yeah. And another thing that I kind of heard between the lines there is like, know yourself first, right? Like you said, know your risk tolerance, know your goals, know your timeline, and then kind of go from that point forward. I think that's important really as an entrepreneur or business person or just a person living a good life, is to know who you are. And that really goes to a lot of different levels of life, really all levels of life, I think, that are important. So how did you get the multifamily vision? Like, how were you first exposed to that?
Great question. Actually, LinkedIn. So, I'm scrolling through LinkedIn and a guy that I actually worked with in the consulting field has got a post about real estate and something about a syndication. And I didn't know what the heck that was. So I just called him. I'm like, hey, what's a real estate syndication? And he was telling me a little bit about it. And immediately I'm like, hey, I remember the last single family home I bought and how much work it was. And he even said it's sometimes easier to buy 100 doors than it is one. And that really got me thinking, because obviously, if you understand real estate, if you understand how to drive value, you can make a whole lot more money if you're doing it at scale with 100 doors rather than one. And so that really fed my curiosity to really lean in and understand more. And that's really what started me on the path of researching the underwriting model for multifamily. And I would say within probably a couple of months, I had learned enough to know that I had uncovered the secret to what I wanted to do in real estate. All of a sudden, I was always thinking, hey, somewhere down the road, I'm going to retire. But now I was like, man, I could actually start thinking about retiring in the next couple of years. If I can figure out how to do this extremely well, then I can choose my retirement date instead of just waiting for the infinite future to happen.
Yeah. From that point of contact with the LinkedIn contact and corresponding with him and kind of catching the feel for, or catching the vision really for what's possible there, how did you go from there? Like, how did you educate yourself to the point that you felt confident enough to move forward?
Good question. So I'm naturally a reader. And so once I know what I don't know, in other words, once somebody plants the idea that, hey, this is something worth looking at. I mean, I don't know if I could name, I might have read a book first, and then that got me with a whole new set of questions. You can Google podcasts, and you can follow a few people. There's some great people in the space. I like the Real Estate Guys radio show. There's a couple of people that just been around forever that are just, even if you're not really into real estate, you know some of these people, they've just been around that long, and you can kind of trust what they have to say. Once I got a general understanding of how do 30 people all get together and kick in $100,000 to produce $3 million to go buy a $10 million asset. Once you walk through that high level understanding, some of the detailed things about syndications, the tax implications and some of the legal implications, you can figure out what do I need to know in an expert way and what do I just need to be familiar with. In fact, that would be one of my suggestions to an LP is there's so much to know. You don't necessarily need to know what is the exact amount of bonus depreciation that I'm going to get on a deal. You just need to know it's out there, and that for a $100,000 investment, you could very easily have $50,000, $60,000, or $70,000 in bonus depreciation. That's something that your general partner can usually tell you about. Exactly what it is doesn't really matter. There's a lot of details in the syndication. Are you investing with your 401k, your self-directed IRA? Like, there are some little subtleties that I would say don't really make a difference on whether you invest or not. There's some of those lessons you just sort of learn with your first one. But backing up, when we talk about LP, I remember 3 key things for evaluating multifamily and what their forecasts are. There were 3 big metrics that always came down to the expected population growth, the expected job growth in that metropolitan area, and then the average salary increase. And really, those were 3. There were other metrics as well, but those 3 really resonated as, if those 3 are all upward trending, then what you're going to see is a consistent, strong demand for housing in that sector from people who can afford to pay for it. In fact, the one negative of those is those people may be wealthy enough to buy their own single family home, which would potentially not be a tenant in multifamily. But as we're seeing in the current market, it's the widest gap between the cost of housing for single family and multifamily ever. And as a result, people just can't afford their own first house, their starter house. And so the expectation is they're going to be in multifamily even longer. So if those 3 metrics are strong, and by the way, they continue to still be strong across the nation, but you do have to look at your metro area, then generally the underwriting models do pencil for multifamily deals, and they make sense to invest in.
Right.
I would say understanding the finances and not just depending on somebody to say, hey, yeah, the average expected return is 15%, but understanding how did they get there is an important thing that a limited partner needs to be more than just casually familiar with. They need to kind of understand that market and understand if those general partners really understand the market.
Yeah, well said. Before I let this one go, were there any particular books that kind of feels like you started with that level of education? Anything in particular come to mind?
Well, it wasn't one of my early ones, but I love Brian Burke's The Hands-Off Investor. It is a checklist of things to consider for, is the general partner doing a good job or not? It's deep and it's kind of hard to get. It's not the sort of thing, it's not a pleasure reading. I think it's really impactful. It's got a lot of great information. There was a point there where I was reading it in the middle of my first deal as a GP. And I'm like using some of his points as, hey, I need to make sure I'm asking my lead partner on, hey, are these things covered? Because my role was capital raise. And so I didn't have some of the depth on leading that particular project. Does that cover your question?
Yeah. Cool. Very well answered. Yeah. Okay. For those of you that don't know Brian, he's a monster in this space and hugely influential guy with, I believe, $1 billion plus portfolio, if I'm not mistaken, has been on the podcast, as a matter of fact. So awesome. That's a great resource there. Let's kind of dive right into that. So as far as Let's start with what you look for in a deal in terms of market. We talked about the metrics that you want to see in a market, job growth, population growth, et cetera. What are you looking for in terms of market? And then at a deal level, what are you looking for?
Well, Tate, let me answer that somewhat indirectly, because I'd like to chat a little bit about the limited partnerships I'm in and why I'm in them, and then I can answer your question a little bit differently than the way you posed it, but I think it's the heart of what you're trying to get at. My first limited partnership, I actually invested in a LIHTC property. For those of you that don't know, that's a low-income housing tax credit. So that's a low-income, it's not a Section 8, it's another program out there that incentivizes developers to buy low-income properties, and they get some great tax benefits as a result of that because they often don't make a whole lot of money. Anyway, they're typically Class C kind of run down, but the great thing about Class C properties is when you can buy the property well below what it would cost to build it, I think you're already in a good place. And what I mean by that is the need for low-income housing is never going away. It's never going to go away. So if you can buy it cheap enough and you can operate it in a streamlined way, then yes, you can steal money. And it was an 8-year hold. I liked the idea of sort of the buy and hold and take advantage of some of the tax credits. I did get a good depreciation out of that particular one. And so I liken that property to what I'd call a dividend stock. So we all know stocks and bonds, growth stocks and dividend stocks. And so dividend stocks, let's give them consistent quality returns, not very likely to appreciate in any particularly big way, but we might see positive appreciation over the years. And so that was kind of my dividend syndication, if you will. And we put a piece of the 401k. It was a solo 401k. I'd moved it from different non-self-directed account into a self-directed account. And so that was the first one. And I let that one go. And the general partners thought that it was going to cash flow. They were going to hold the first 3 months as part of their reserve. And then months 4 or 5, it would start cash flowing, and it followed its schedule. And then the next one that I invested in was a development deal. It was so pre-entitlement. And so this is an important thing because your pre-entitlement means it's just raw land and there's no permits. And pre-entitlement means you may not actually get permits. There's definitely a risk there, but the rewards are also commensurate with that risk. And so it was an 18 to 24 month project that was going to have, I think it was about a 55% projected return in that time period. So it had a great, I don't know what the average rate of return was. It was in the high 20s somewhere. And I really liked that. But you do need to understand that it's quite a bit more risky, because if for some reason you think you're going to build 29 units and there's a problem with trees or there's a problem with, you name it, some sort of zoning or other problems, you may not get 29, you may get 20. And that clearly impacts your profit profile. But that's why the higher returns are projected, because there's higher risks. So I felt like by having sort of one dividend stock and one growth stock, I thought, hey, it's kind of like having a balanced stock portfolio.
How did that one go on the development side?
So that one is probably halfway. If you're used some terms, horizontal. The horizontal is all the land and the groundwork is done. And that project is just starting to go vertical, meaning physically build the actual buildings. And so the expected completion date is the first quarter of next year. So it's generally tracking. When it was getting started on some of the land development, it was a bit of a boon for developers. It was actually hard to find a good construction company to get started. So there was a little bit of a delay in bidding that out because there just wasn't a lot of availability when it got started. But it's going like it should. Oh, I forgot to mention, just like growth stocks, there's no dividends on these. There's no people in these units, right? And so you don't make money until the back end. This particular one is 29 individual homes that are going to be sold. I was actually chatting with somebody just this week, was there a chance for BTR, which is build to rent? And yes, I think somebody might come in, buy all 29 and make it a BTR community, but that's not this particular syndicator's goal. Their goal is to sell the individual units. They're in the Charlotte, North Carolina metro area. They're not but about 4 or 5 miles from what Charlotte calls their downtown, uptown. And it's right there close to uptown where a lot of strong jobs, banking's big in that city. So kind of gives you an idea of the growth in the dividend stock. And so for my next investment, I said, all right, let's go back to multifamily value add. There was a brand new Class A building on the water in Sarasota, Florida. Sarasota in Tampa metro area had great potential. I think I got into that one about midsummer of last year. And it was a very desirable property. It just couldn't look better. And because it was brand new, we expected maintenance costs to be very, very low, really expected turnover to be low. It was leasing up great. The builder had actually built it and then started leasing it. The leasing was going strong. And it was in that process that they were selling it to the syndicator who was going to do a 5-year plan for it. Had great bonus depreciation. That one's a neat lesson learned because it was hit by a hurricane about 4 months later. And so it's just the reminder that these are physical assets and stuff happens. I was really impressed with the general partner team because they said, look, we're just letting you know that there was a hurricane. As soon as we get an update, we'll get news out to you. There really wasn't property damage. There was some minor things that happened, trash and stuff that had to be cleaned up. There really weren't significant repairs, but there was an impact a few months later when it came time to renew that insurance premium. The insurance premium increased some crazy number, like 30 times.
Wow.
Yeah, I was really impressed. The general partnership team did some kind of reinsurance with Lloyd's of London, where they're really using Lloyd's of London for what do they call the extreme insurance? I'm stalling on the name, but the point is that they're sort of
catastrophic or whatever.
There you go. That's the word I was looking for. So they're really doing catastrophic insurance with Lloyd's of London. And so their deductible is this crazy number, and they just bounced up their reserve. But the alternative was going to be to pay the kind of money that they were looking at setting aside for a reserve every single year. So it just didn't make financial sense.
Mm-hmm. Awesome. Okay. So quick question on just to backtrack for a second on that entitlement deal. Did everything go as expected and wanted in the entitlement process? Did you guys get what you wanted out of that?
That one did. So it was 29 similar townhomes. It was in an area that the city wanted to redevelop. So they were welcoming the new development in that particular area. And it was just a really cooperative thing where the city wanted it. It all comes down to sometimes even when the cities need it, they don't always want the new development. And so they were very, very cooperative. And that one went pretty well.
Yeah, it really pays to know the city and to know what master plan may be in place on the development side. And we're not at Greenlight. We're not experts on multifamily development. It hasn't been our model, but we have done a little bit with it, even on the single family space. And like you said, there is risk there of things you not getting what you want, and that can change the deal quite a bit. And then on the Florida deal, how has the increased insurance affected projected returns, I guess?
It wasn't a huge number. I don't know that I went back and calculated the percent, but it wasn't. Once the Lloyd's of London policy went through with the catastrophic insurance, it was not as a significant expense item. One of the things that the rent increases had outperformed the original estimate. So that sort of buffered some of the additional cost. Now that you ask me, I'm going to have to go back and look at the projected return versus what was actually delivered. That's one of the ones that is just paying into my solo 401k. So I don't frankly look at it as much as like a bank account one that you see all the time. The 401k, I usually look at it like the end of the year and I'll do a comparison of what was the projected and what was the actual. But I haven't actually looked at it since probably December of last year.
Got it. And what's the plan on that one as far as what's the modeled hold time and what's your disposition plan on it?
Well, remember, I'm a limited partner on that one. So the general partner's plan is the traditional 3 to 5 year hold. I think they were really sort of leaning on the conservatively modeled rent increases, I think around 3 or 4%. But the reality is there are places in Florida that are seeing double digit. I think the Tampa area was something like 10 or 11% last year. And so that really can help when you're going to make money at only 3 or 4% rents raised, but you get up around 10 and you're looking at 3 years of movement in a single year. So yeah, I think that one's going to be fine. And I think one of the things though that they're going to have to look at is when do interest rates and cap rates and when do we get past where we are right now? I think there are some people out there kind of holding their breath. I think the reality is that you can buy and sell real estate at any time. That the numbers just have to make sense.
Right. Yeah, totally. Okay, awesome. And then I think you're in a fourth deal as well, aren't you?
That's right. That's right. So the last deal I was in, it was the 96 unit Class B. What really attracted me to that one is the existing rents were about $200 to $250 a door under market rent. There was just an immediate opportunity for forced value. So even if you just did that, there was some really nice net income that was going to come out of that when you multiply that. by the cap rate sort of multiplier. It was just a lot of money that really could have been taken before the sale, but for whatever reason, whether it was poor management or just, I don't know, some people just fall into a stupor when it comes to paying attention to market rents. So that one really had a great short term. And then that was a 3 to 5 year hold as well. And so that one is tracking extremely well because the market was strong. It was a Class B product in an area that really needed it. And there was no trouble getting the higher rents. And so now, obviously, they have to wait for the tenants to have their leases run out before you can make any changes. But that's tracking nicely. That was probably closed last September, October, and the last 8 or 9 months have been good.
Did you guys have to do any improvements on a unit by unit basis to get rents to where you wanted to get them?
There was, I think it was a vintage 1996. And so it was really mostly cosmetic. The appliances looked good, the roofs, the foundations, a lot of the things. There was a little bit of paint on the outside. There was a little bit of parking lot, but they weren't really big dollars. There was a capital budget. I'm trying to remember what the biggest capital budget might have been. I'm kind of drawing a blank right now, but it was manageable. I mean, it was mostly cosmetic, and that really didn't move the needle on the expense.
Yeah, it seems like when you have a premium available, $200, $300, whatever, it's pretty rare that you can do that with in-place conditions, like current conditions. Usually needs some attention at some level. We're typically looking at deals where there's anywhere from, let's say, a $4,000 to $10,000 per unit remodel needed to get a $300 rent premium, right? Because you're trying to compete with those top comps in your market as far as rent comps go. And a lot of times, if they're that much more than what you've got, you need to get stuff up to that standard.
Right.
That said, like when you can find those operational opportunities where either current management just hasn't kept up with rents, which is often the case, or even occupancy, those are really nice opportunities typically to come in and just make some operational changes and get your NOI up.
Right. Yeah. Agreed.
Awesome. So let's take this to what you look for. It's pretty clear what you're looking for in deals and where you see the opportunities there. What do you look for in a GP team to invest with?
Great question. Integrity. So I think my way of getting to know people, because there's a lot of different ways, you can't just assume the other person is who they say they are. That's the world that we live in, right? So I really like referrals. I like somebody that I trust says this is somebody that they trust and they have a need for my skill set and I have a need for theirs. I look at what is the team's experience, right? I don't want to hear that we've got 80 years of experience between the team. I want to hear that you were a lead for the last 5 deals and another guy was been underwriting. Maybe he was a commercial underwriter, right? He worked at a bank for 10 years and the guy that's well, I'm usually the capital raiser. So we've usually got somebody finding deals, which is often like somebody with a brokerage type background. We got somebody that's underwriting the deals and they've got a commercial background. Those are the people you want to work with. Somebody might say, well, why would somebody want to work with you with only 2 years? And the reality is, because I think I was a good limited partner, I think I'm a better general partner to talk to people about how to be a good limited partner. It's fairly fresh. I'm very open about what I'm good at. And so I don't misrepresent anything. So when I said something about integrity is I want to hear a general partner tell me what they're good at and what they're not good at. Yeah. And I want to see where I fit in there. If you tell me you're good at everything, then you don't have a need for me. You're probably blowing hot air, right? Mm-hmm. There aren't too many guys or gals that I've met that really do fire on all cylinders for multifamily because they're just totally different skill sets that you learn through experience. Yeah. I look at experience, and one of my big litmus tests is I just got to like working with the person. This isn't like my W-2. If it's a lot more like dating. If I don't like you, I don't call you and ask you out again, right? But if I'm into you and you're into me, then it's mutual and it's a relationship, right? It's very similar to the dating world in that way.
Great analogy for a single guy on this side of the microphone. Yeah, I can totally relate to all that very well. So yeah, and well said. I mean, there is a huge amount of importance and value in liking who you're working with. I think that, just some of those intangibles, and let's face it, life's short, right? So working with people that inspire you and support you and kind of you just like being around, like bring you joy and happiness is kind of irreplaceable, really. And it's hard to quantify, of course, but I'm really glad that you hit on that because I think that's incredibly important. And for listeners, whether you're looking at being an LP, a GP, capital raiser, co-GP, which is part of the GP, that's really something to, I think, look at a primary level is like just the rapport and chemistry that you have with somebody and how well you can relate to them really at a personal level. And then if you're looking at, this goes really on steroids, this conversation, when you're looking at like long-term partnerships, right? Like bringing somebody into your company as a permanent partner, that this particular aspect is just massively important because you're married, you're in it legally, you're in it financially, and you're going to be working with that person for a long time. And challenges are going to happen, right? Like setbacks will happen, obstacles will come up, and how you deal with that together as a team means everything. So yeah, really well said, Jerry. Anything else on that?
Yes, Tate, one more golden nugget to really evaluate a general partner team is ask them something that went wrong and what they did about it.
Yeah.
Right. The general partner team in Tampa could not have controlled getting hit by a hurricane, but they pivoted, they figured out what to do, and they executed. And that's a good general partner.
Yeah.
And if the general partner can't tell you of when something went wrong and what they did about it, it's because they haven't been around long enough and you've had to do something about it. And so I really think it makes a difference. If somebody doesn't have an example, that might be a sign of inexperience.
Mm-hmm.
If somebody has an example of something that went wrong, you're not moved by what they did about it. Well, that might be a sign of, I don't want to say incompetence, but they may not be the strongest operator. So that's just a great way to kind of uncover how long they've been in the space and what they've done when the chips were down.
Yeah, really well said. Okay, cool. So I guess kind of looking forward from here, Jerry, as far as you personally, you've taken on becoming a GP, and on the GP side, your specialty is raising capital for these deals. And of course, any capital raiser on a GP needs to have other roles per SEC regulations and requirements. I'm sure you participate in other aspects of the deal, and whether that's asset management or due diligence, that sort of thing. But what's next for you?
Great question. So really building the capital raising machine, if you will, right? You got to be an expert at social media to continue to attract new investors, really just go deep on some of your podcast and getting other educational collateral on my website to just educate people. I feel like capital raising is not asking people for money. Capital raising is educating intelligent investors and seeing where there's an alignment. That's really been a great strategy for me. I'm very straight up with my investors because, again, I want them to see what I see. And when they do, they're like, I'm all in. I want to be a part of this. And that's the person I want to work with. I do not want to drag anybody into a deal. There's too many things that you can do with your life. And so I'm going to continue. And I love talking asset strategy with my general partners. What are we going to do? How are we going to do it? How long will it take? I just love real estate in general. So it's kind of fun to talk about how are you going to transform this apartment complex into a better place to live and at the same time make more money. It's just a fun thing to do. So that's kind of it for me, just to continue with partner with really great operators and just continue to raise more and more funds for different deals around the country.
As internally, will you look to expand at all in terms of your own team and your own infrastructure?
So that's a great question, Tate. I don't know. I don't need to right now. I do have VAs. There's a number of different tasks that I can definitely appreciate their help. But generally, to date, I have partnered with almost fully formed teams. And what I mean by that is they check all the boxes on everything except they didn't have the ability to raise all the old capital. So I'm really learning a lot from them and their skill sets. And that's kind of fun. Maybe there'll come a day where I find a deal and I really want to do it myself, and I would be fine with that. But right now, I'm just having so much fun doing what I'm doing. I'm not in a hurry. You know, it's organically when the right deal comes along and I've got all of the right tools and maybe I can bring somebody on my own team, I would consider it. Sure.
Yeah. I want to ask you about your VAs, and in particular, I want to ask you about your social media approach and your attack there, like how you strategically use social media to build your business. Because I agree with you that has got to be a central part of what you're doing is your social media presence. I guess, what platforms are you using? What strategies are you using? Are you posting videos? Are you posting blog posts? What do you do there?
So we're on LinkedIn, Instagram, and Facebook. Each of those is really a different demographic in terms of the age of the investor. I think LinkedIn is probably my primary investor, in that it's folks that are kind of my age that are probably corporate America. It's really the business social media, I believe. We are posting one post a day, Monday to Friday. It's typically like a tagline or something to attract some attention in front of a nice graphic. And then within the caption, a lot of education. This is where interest rates are today, and just different things. If I hear an investor say, well, Jerry, I think I want to wait until, interest rates come down to invest again, that'll usually drive me to think, well, historically, what have interest rates been? And I actually produced this graph for him to say, hey, do you know that in the last 40 years, that we are at the average interest rate of those last 40 years? The problem is the last 10 years has reset normal for you. It has been below normal for almost all of the last 10 years. Just a few years before the pandemic, we started to tick up, but even then we were still well below historical averages. So when you reset the number and you realize, well, if we're only at an average interest rate right now, then what are you worried about? I think a lot of the panic and a lot of the concern is how quickly we increased that interest rate, and that caught a few people off guard, and it certainly changed. A deal may pencil at 3% that doesn't pencil at 7%. But anyway, when I hear a concern or a comment, I usually like to go get some data, and then we try and find a way to turn that into a post on social media, and inevitably somebody will be like, hey, I'm kind of interested in your thoughts on interest rates. And the goal, of course, is just to engage them in a conversation. And if they're thinking about investing, then we educate them a little farther and possibly turn them into an investor.
Yeah. For listeners, like LinkedIn, to me, it's just essential. It's just an essential platform, and it's high impact, right? And you can grow your connections on LinkedIn way faster, especially than Instagram and even Facebook. Like, the ability to connect with people efficiently, quickly, and grow your audience quickly on LinkedIn is tremendous. And then on the consumer side, the amount of wealth of information and ideas and model, et cetera, like, there's just so much there that if hopefully you're on LinkedIn, if you're not, get on LinkedIn and look at, first of all, like, really focusing on your bio and your page, right? Like, pick a few high power influencers in the space that you're in and look at what they do, what they offer, how they describe themselves, and how they describe what they offer other people, what the opportunity is. Like, if you look at a really good LinkedIn influencer, the first thing you're going to see in their bio is what they can offer you, what they can offer anybody in the space. And maybe, listeners, that's a big takeaway from this episode, is to really turbocharge your LinkedIn presence and take advantage of that. I'm coaching myself here as much as anybody. There's always an opportunity to level up. And LinkedIn, in my opinion, is one of those very ripe opportunities. I do want to mention one thing. I believe towards the beginning of the episode, I referred to capital raisers as LPs. And that's, if I said that, I misspoke. It's people that are like Jerry at this point, that are bringing together investors and raising capital for specific deals, are on the GP, on the general partnership. And sometimes we refer to that position as co-GP, if you will. That's kind of a slang term for it. But so just to be clear on that, didn't want to misspeak on that. And really, like, just to simplify, an LP, like, very simply, their only role in the deal is to bring capital, right? Like, they're not doing anything else at all other than educating themselves and making the investment. So awesome stuff, Jerry. So again, just how do listeners reach you and connect with you and learn all about you?
Absolutely. So again, the website's www.largogroup2011.com. Largo is after Key Largo in the Florida Keys. If anybody's interested, it's an interesting story that I won't get into now. You scroll all the way to the front page, and there are links to Instagram, LinkedIn, and Facebook. I'm probably the most active on LinkedIn, but whatever social media works for you, you can connect with me there. I'm happy to help you in your real estate education and whatever might be next for you. I just love talking about real estate, so it's never a bother. You can book a call from there, but usually I like people to read in a little bit on some of the collateral I've already created to kind of help you see what my investment thesis is. I tend to work the most with small business owners and IT executives. Because I came from the IT background, I have a lot of like IT analogies that I like to use with them. But I also like the mindset of the small business and medium-sized business owners because they have an owner's mentality. They tend to view the world. There's an innate understanding that you have to risk something for a reward. If you've been very safe in your life, you might feel like, why would I want to risk anything? And the answer is because the rewards are worth it. But you have to arrive at your own decision that a reward is worth a risk. So yeah, those are my thoughts.
Well said. Well said. I think we'll leave it right there, Jerry.
Cool.
Lots of great stuff here. Listeners, hopefully you got a lot out of this and took some notes. If not, go back and listen again and make sure that you really get this LP opportunity. One thing that hasn't come up in this episode yet is being an LP on a syndicator's deal, that somebody that you trust, somebody that you have vetted, and somebody that shows an interest in keeping you abreast of the deal and things that come up, even including you in maybe asset management meetings occasionally, that sort of thing. That is one of the best ways to get into this business. If your goal is to be a GP and either a lead sponsor or be on a GP team, being an LP first is a tremendous way of breaking into the space. And so consider that too. Like, it's very, very valuable experience. So
I agree, Tate. I agree.
Yeah. Awesome. Jerry, thanks a ton, man. I really appreciate you being here and sharing with us, and look forward to continuing our conversation and together and being in the mastermind together and growing. And if there's ever anything that we can do for you here at Greenlight, love to collaborate at some point in the future, and, wish you all the best. It seems like you're up to some really cool stuff and on a really cool path.
Thanks a lot, Tate. Really enjoyed you having me on. Thanks a lot.
You're welcome. Listeners, thank you for listening to the end of another episode of the Apartment Gurus, and just appreciate you guys so much. I say it every episode, but really appreciate you guys and the opportunity to hopefully enhance your world, your business world, and your entrepreneurial path. So we're doing 2 of these a week as usual. And so we'll see you back here in a couple of days on the Apartment Gurus. Take care, everybody.
Take care.
This episode of the Apartment Gurus is being brought to you by Greenlight Equity Group. Greenlight Equity Group acquires and operates cash-flowing multifamily assets in progressive metropolitan markets such as Salt Lake City, Idaho, San Antonio, Oklahoma City, and Columbus, Ohio. Greenlight targets consistent, solid returns for its investors and a healthy environment for residents by operating high-quality, safe, clean, affordable apartment communities. To learn more about Greenlight and to sign up for the investor list, go to www.glequitygroup.com.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.